Hello friends, welcome back. TDS chapter revision is going on for CA final AY 25-26. TDS chapter in part 1 we discussed 30 sections out of total 41 sections. 30 are done in part 1, section 192 to 194T. Now today in part 2 we will be discussing remaining 11 sections and then some other compliance provisions, the responsibilities attached to TDS. 194T was the last section, next is 194LA. On 194LA, not many questions have come, hardly 2 or 3 questions must have come. 194LA is a 10% TDS on compulsory acquisition of immovable property. Compulsory acquisition of immovable property other than agricultural land. Whether agricultural land is in a rural area or it's an urban area. Any person ideally will be government or government body or RBI or collector of state government. While making payment to any resident person for any compensation or enhanced compensation or consideration for compulsory acquisition of certain immovable property other than agricultural land, in case where the compensation is more than 2,50,000, 10% TDS will be deductible. However, no TDS in case if the compensation is exempt under section 96 of RFCT LARA. RFCT LARA 2013. Section 96. RFCT LARA means Right to Fair Compensation and Transparency in Land Acquisition and Rehabilitation and Resettlement Act. It's a very big name, no need to remember the whole name. Simply, if it is exempt under some other act, then here no TDS, here also exemption will be provided. 194LA, whenever questions have come, questions have been always straightforward. Next is 194LB, Infrastructure Debt Fund paying interest. If the interest is paid by Infrastructure Debt Fund to its lender, if non-resident, Infrastructure Debt Fund we had discussed in special rates of tax, it is similar to mutual fund, but we are not talking about Infrastructure Debt Fund making payment to its unit holder. That payment is different payment. We are talking about those who have lent money or given loan, that is lender. Lender has given money to or given loan to Infrastructure Debt Fund and Infrastructure Debt Fund is paying interest. This interest without any limit will be subjected to TDS at the rate of 10%. However, this is applicable only if TDS will be under 194LB, only if lender is non-resident or a foreign company. If lender is resident, then TDS will be under section 194A. Very simple section, questions have never come. Payer is Infrastructure Debt Fund referred to in section 1047, whereby Infrastructure Debt Fund's own income is totally exempt. Making payment to any non-resident or foreign company of any interest, TDS will be at the rate of 5%. Of course, plus surcharge plus health and education cess because paying to non-resident. In case if paid to resident, then TDS will be under section 194A. Then the next three sections are 194 LBA, LBB, LBC. 194 LBA, LBB and LBC are all three in synchronization. LBA, LBB, LBC. Who are these three sections for? Here the payer would be business trust. If you recollect BT, business trust can be REIT, REIT or can be INVIT, Infrastructure Investment Trust. Next is investment fund and 194 LBC, Securitization Trust. If you recollect, I had been telling you BIS, Bureau of Indian Standards. Easy way to remember it. Then we had even, while discussing these three chapters, we had prepared a chart also making comparison between these three chapters. Now here they will be deducting TDS while making payment to unit holder, while making payment to unit holder, while making payment to investor. Here the investors are called as investors and not unit holder. Business trust is registered with SEBI. Investment fund is also registered with SEBI. Securitization trust requires three types of registration. Requires registration with SEBI plus RBI plus under SARFAESI Act. Securitization and Reconstruction of Financial Assets and Enforcement of Securities Interest Act. Okay. Now here payee could be resident or non-resident. If resident, then TDS is applicable generally at 10% rate. For business trust, TDS will be at 10% rate if resident. Investment fund also will be at 10% if resident. But in case of securitization trust, it will depend upon the further legal status. A payee is resident but is individual HUF then 25%, other than individual HUF then 30%. 10, 10, 25, 30. And if non-resident or a foreign company, then rates are different slightly for these three chapters. One by one we'll be discussing. First of all, business trust. Let's start with business trust. If you recollect, three incomes of business trust are exempt. Whatever is exempt, when passed on to unit holder, in the hands of unit holder, such incomes will be taxable under pass-through status. Which three incomes are exempt in the hands of business trust? For business trust, number one, incomes referred to in 1023 FC subclause A, that is interest income, but which interest? Not any interest, interest from SPV, special purpose vehicle. Second, 1023 FC subclause B, dividend from SPV, dividend from special purpose vehicle. And third is rental income from directly owned real estate assets, exempt under 1023 FCA, directly owned real estate asset. These three incomes are exempt. When these three incomes are passed on to unit holder, for unit holder all the three incomes are taxable. TDS will be applicable under 194 LBA on these incomes, these three incomes, which are exempt for business trust but are taxable for unit holder. When business trust passes it on to unit holder, for unit holder it will be taxed as per regular rate, whatever is the rate applicable to unit holder, but TDS will be at a fixed rate. What rate? 194 LBA. Which income? Distributed income referred to in 115 UA, which is exempt in the hands of business trust under 1023 FC subclause A, 1023 FC subclause B and 1023 FCA. Business trust, while making payment to unit holder, whether resident or non-resident, will have to deduct TDS. If paying to a resident unit holder, TDS rate will be 10% flat. But if paying to non-resident, then these three incomes will have different rates. If this income is paid, interest from SPV, then 5%. If dividend from SPV, then 10%. And if rental income is distributed to unit holder, TDS will be at the rate in force. Rate in force means rate given in Finance Act, which will be 35% in case of foreign company. If the payee unit holder is a foreign company, then till last year it was 40%, which is now changed to 35% from current year onwards. And if paid to other non-resident, then the rate will be 30%. Where did we get this 30% from? 30% is the rate given in Finance Act. In Finance Act of any year you pick up, Finance Act has a list of sections, a list of incomes where for which income how much TDS will be deductible. These are the rates given in Finance Act for TDS purpose, and in this list, which runs into 2-3 sides, last item is residuary items, any other income payable to non-resident. If foreign company, then 35%, if other than foreign company, then 30%. This is the rate for TDS. I am not saying that unit holder will be taxed at so and so rate. Unit holder will be taxed if he is individual or HUF. Non-resident will be taxed as per regular slab rate under old tax regime or the new tax regime. TDS will be at so and so rate. Plus surcharge plus health and education cess, of course, that goes without saying. Because the payee is non-resident or a foreign company, then TDS rates have to be increased further by surcharge and health and education cess. We know that. 194 LBA is over. However, in 194 LBA, one small thing I would like to bring to your notice. Out of the three incomes of business trust, which three incomes? Interest from SPV, dividend from SPV and rental income. Out of these three, as far as dividend income is concerned, for business trust it is always exempt. Which dividend? Dividend from SPV, not each and every dividend. But in the hands of unit holder, whether it will be taxable or not, that depends upon whether this SPV has taken or has applied for 22% tax rate under 115BAA or not. So if you recollect that chapter, if SPV paying dividend to business trust and then business trust passing it out to unit holder, if SPV has taken or has opted for 22% tax rate, then for business trust it will still be exempt. For unit holder it will become taxable and accordingly TDS will be applicable. TDS under 194 LBA applicable. But if SPV has not opted for 22%, has paid tax as per 30% or 25% rate and passing it on to business trust, for business trust it will still be exempt dividend from SPV, but for unit holder also it will be exempt. Meaning thereby, out of three people, For business trust, dividend from SPV is always exempt. In unit holders' hands, it will be taxable or not. That depends upon whether SPV has taken advantage of 22% tax rate under 115BAA or not. Simple language, if SPV is being benefited, then SPV has taken benefit, then unit holder will not get benefit of exemption. If SPV has not taken benefit of 22% tax rate, then unit holder will get the benefit of exemption. Simply, either SPV or unit holder, any one of them will get the benefit. For business trust, benefit is always available. For business trust, dividend from SPV always and always exempt. If taxable for unit holder, then only TDS will be applicable. So that was the thing. So note, I have mentioned that no TDS in case if business trust is distributing dividend from SPV to unit holder if SPV has not taken advantage of 22%, has not opted for 22% tax rate under 115BAA, then unit holder will be exempt. If unit holder is exempted on this dividend, then no TDS. Next is 194 LBB, investment fund. If you recollect investment fund, then only one income is taxable for investment fund. Investment fund will be taxed for PGBP income and that income will be exempt for unit holder. If income is exempt for unit holder, then no TDS. No TDS. But if investment fund earns any other income other than PGBP income, then it is exempt for investment fund but is taxable for unit holder. If it is taxable for unit holder, there will be TDS. TDS will be under section 194 LBB. At what rate? So answer, if unit holder is resident then 10%. If non-resident, then at rate in force. What do you mean by rate in force? Rate in force means rate given in Finance Act, which will be 35% for foreign company if unit holder is foreign company, or it will be at 30% rate in case if non-resident is other than foreign company. Okay. So at the rate in force in case of unit holder being non-resident and 10% in case of unit holder is resident. So 194 LBB, investment fund while making payment to unit holder under pass-through status, which income referred to in explanation 1 to 115 UB. That means income other than PGBP income. Because PGBP income will be exempt for unit holder, so no need to deduct TDS. Other than PGBP income is exempt for investment fund, taxable for unit holder. Whatever is taxable, TDS will be applied only on that. If unit holder is resident, then 10% flat, just like business trust. If unit holder is non-resident, then at the rate in force for foreign company 40% is cancelled now, 35% will apply, and other than foreign company, other non-residents, then 30%. 194 LBC, Securitization Trust, BIS, Bureau of Indian Standards. While paying to its investors, here we don't call them as unit holder, we call them as investor, whether resident or non-resident. Which income? The answer here, Securitization Trust, each and every income is exempt for them. Income from the activity of securitization is exempt under 1023 DA. So whatever income they distribute to unit holder or investor, everything will be taxable in the hands of investor. If investor is resident, then TDS rate will depend upon whether investor is individual HUF or other than individual HUF. If resident, then 25% and 30%. 25% if individual or HUF, and if other than individual HUF, then 30%. And if payee, investor is a foreign company or non-resident, then rate in force. And rate in force means foreign company 40% instead of 40%, now it will be 35%. And if other than foreign company, other non-residents, then 30%. Of course, plus surcharge plus health and education cess. In none of the three sections, we have to bring into picture DTAA rate. DTAA rates are not to be brought into picture. DTAA rates, when the assessee, unit holder or investor, when he files IT return, when he calculates his tax, he can take into account DTAA rate, but for TDS purpose, DTAA rate not to be brought into picture. Okay, next is 194 LC. This section we had studied in detail in chapter called chapter 12, special rates of tax. Here, payer is any person, payee is non-resident or a foreign company. Payee is non-resident or a foreign company. Who's the payer? payer should be Indian company or a business trust. This section we had studied in chapter 12 special rates of tax plus in business trust chapter also. This is the third time we will be studying it. Either business trust or Indian company. What is business trust? You know pretty well. Indian company also we know. They paying interest to them. If three conditions are satisfied, then TDS will be deductible here. TDS rate here will be 5%. If some conditions are fulfilled, then 4%. And if some conditions are further fulfilled, then 9%. Of course, plus surcharge plus health and education cess, that is needless to say. Okay. So, which are the conditions? Three conditions. First condition is payer should be so and so, so and so. Payer should be business trust or Indian company. Secondly, borrowing should be in foreign currency. Borrowing in foreign currency. And third condition, borrowing should be by way of either issue of loan agreement, or by way of issue of long-term bonds, infrastructure or any other bonds. And third, by issue of rupee denominated bonds, which are also called masala bonds. Of course, these three, there are dates also applicable. If loan is taken between so and so date to so and so date, long-term bonds are issued between so and so date to so and so date, or rupee denominated bonds issued between so and so date to so and so date. Primarily, if conditions are satisfied, TDS rate is 5%. Incomes we discussed in section 115A subsection 1 clause A in special rates of tax chapter. There also same tax rate was there. Here same surcharge rate, same section rate and same rate for health and education cess 4%. Now what are the dates related condition that we will discuss? This was part A. When will 4% apply and when will 5% apply? When will 9% apply? So in case if the loan is taken or the borrowing is made by way of issue of rupee denominated bonds between 1st April 2020 to 30th June 2023, and these bonds are listed only on a recognized stock exchange located in International Financial Service Center, listed only on a recognized stock exchange located in IFSC, then 4%. Rupee denominated bond is appearing here also, 5%, and here also. But when will 4% apply? 4% will apply if further conditions are satisfied. It should be listed only on recognized stock exchange, and that recognized stock exchange is located in IFSC. These conditions are satisfied, then slightly lesser TDS 4%. And same rupee denominated bonds or long-term bonds, RDB in fact, if issued on or after 1st July 2023 and listed on a recognized stock exchange located in IFSC, then the TDS rate will be 9% and the tax rate will also be 9% in section 115A subsection 1 clause A. Okay, so payer Indian company or business trust, payee any non-resident or a foreign company. Then right now we will discuss about 5%. When is the 5% applicable? So if interest on money borrowed in foreign currency from outside India, either by way of loan agreement between 1st July 2012 to 30th June 2013, or by way of issue of long-term infrastructure bonds between 1st July 2012 to 30th September 2014, 2 years, or issue of any long-term bonds including long-term infrastructure bonds issued between 1st October 14 to 30th June 2023. The last, issue of rupee denominated bonds RDB anytime up to or anytime on or before 30th June 2023. Here starting date is not given, unlike first 3 points. Starting date is not given, but ending date is given 30th June 23. Now 30th June 23 agreed happened in last year, financial year 23-24, but this section still applies, meaning thereby the time limit or the deadline of 30th June 23 is for borrowing funds or issue of bonds or issue of RDB. Once issued or once the loan is taken up to 30th June 23, then this section and the rate given here will apply lifetime. It's not for a temporary period. Same long-term bonds or rupee denominated bonds are issued between 1st April 20 to 30th June 23 and they are listed on a recognized stock exchange, only in a recognized stock exchange located in IFSC, then TDS rate will be 4% for the same payee. And in case if the long-term bonds or rupee denominated bonds are issued on or after 1st July 2023, last year, and listed only on a recognized stock exchange located in an IFSC, then the rate will be 9% with the same type of PE. Everything is same, it's just that dates are different depending on the dates. And once issued on or after 1st July 23, then ending date is not there. Lifetime TDS rate will be 9%. Then there was one section called 10(4)(c), whereby interest on rupee denominated bonds will be exempt if the rupee denominated bonds are issued between 17 September 2018 to 31st March 19. Between these two dates, this was around 6 months, September to October, November, December, January, February, March. During this 6 months period, if the rupee denominated bonds were issued, then interest will be exempt lifetime and accordingly no TDS will be applicable under this section. 194 LC, slightly important from exam perspective. 194 LD is the next section. Here payee is FII or QFI. Interests are paid to foreign institutional investor or qualified foreign investor. This section also we had discussed in special rates of tax chapter 12. TDS rate will be 5%, of course, plus surcharge plus health and education cess. Whenever the payee is non-resident or a foreign company, surcharge and health and education cess are always to be attracted. Health and education cess will always be attracted. Surcharge will be attracted only if the payment to them exceeds the limit at which surcharge is attracted. If the payment is more than 50 lakh up to 1 crore, then 10% surcharge. If the payment is more than 1 crore up to 2 crore, then 15% surcharge. Payment is more than 2 crore but up to 5 crore, then 25%. And if the payment is more than 5 crore per annum, then surcharge rate will be 37%. Indian company or government of India, 3 types of interest. Number 1, interest on rupee denominated bonds issued or payable between particular dates, interest on government securities, and third is interest on municipal debt security. Interest on rupee denominated bonds, interest on municipal debt securities, interest on government securities. Subject to dates, interest on rupee denominated bonds, if payable, or interest on government security payable between 1st June 13 to 30th June 23. Now in this section, the ending date 30th June 23, which is same as 194 LC 30th June 23, but in 194 LC preceding section, the date was for issuing the bonds or for borrowing funds by way of loan. Once borrowed up to 30th June 23 or bonds are issued up to 30th June 23, lifetime that 5%, 4% etc. will apply lifetime. But so is not the case out here. This section has become redundant now because here the date is with regards to payment of interest. If the interest is paid or payable between these two dates. So if the interest is payable today in financial year 24-25, this section and this TDS rate will not apply. Okay. Or interest on municipal debt securities payable between 1st April 20 to 30th June 23, payable between so and so date, and payable means if payable up to 30th June 23. After that, this section becomes redundant. There is no extension in this section. 195 is an important section. TDS by any person making payment to any non-resident or a foreign company. Which payment and what rate? Here type of payment is not given. This is a residuary section. Residuary means just like income from other sources, anything which does not fall under other sections will fall under this section. Meaning thereby, out of total 41 sections of this chapter, out of total 41 section, there are 20 sections other than 195, 20 section where payee could be non-resident. Payee could be non-resident or a foreign company. I am not saying payee has to be non-resident or a foreign company. For some of these 20 sections, payee has to be non-resident, not applicable for residents. And for some of these sections, payee could be resident or could be non-resident. Remaining 21 sections, payee has to be resident only, applicable only for resident payee. So here, for example, 20 sections where payee could be non-resident, say 192 salary, 192A EPF account withdrawal, 194B winning from lottery, crossword puzzle, card game, gambling, betting, 194BA winning from online games, net winning, 194BB winning from horse race. Sections that we just discussed, 194 LB, LC, LD, 194 LBA, LBB and 194 LBC. These sections, the payee, here payee has to be, for these three sections, payee could be resident or non-resident. Some of the section payee has to be non-resident, and if you recollect, non-resident sports association, sports person or non-resident foreign national entertainer, 194E, 20% TDS rate. Here the payee has to be non-resident only. So for some section, payee has to be non-resident only or foreign company, and in subsection, some of these sections payee could be resident or non-resident. There are such 20 such sections in totality. If TDS is applicable under these 20 sections, first priority will be given to them. If TDS not attracted under these 20 sections, then second priority will be given to 195 section. So 195 section is applicable as a second priority whenever payee is non-resident or a foreign company. This is a section where rate of TDS is not given. It says that tax shall be deductible either at the rate in force. Rate in force means rate given in Finance Act or the rate given in Income Tax Act. Rate in force simply means rate applicable, or DTAA rate. Here DTAA rates are to be taken into account, whichever rate is lower. And before we proceed further, let me remind you, rate in force, that is rate given in Finance Act or Income Tax Act, are required to be increased further by surcharge and health and education cess, whereas rate given in DTAA are not to be increased further by surcharge and health and education cess. Coming back here, so 195 is payment of interest or any other sum which is chargeable to tax in India. So here TDS will be attracted only if the amount paid by you, the resident, to the non-resident should be taxable in India in the hands of non-resident. Interest or any other sum which is chargeable to tax as income, but other than salaries and other than those incomes which are covered by other sections of this chapter where payee could be non-resident, other than those 20 sections. First priority will be given to those 20 sections. If they fail, then only priority will be given to this section. Here rate is not given, rate specified in the Finance Act or the rate given in DTAA, whichever is lower will be applied. Very simple section, but in real life it creates lot of practical difficulties. Anybody making payment to a non-resident will have to deduct TDS. Here it is not necessary that the payer should be resident only, payer could be non-resident also. So imagine one non-resident making payment to another non-resident. Then the question arises whether tax should be deducted or not. Answer: tax may have to be deducted if the income is chargeable to tax in India in the hands of recipient. If he is taxable, then TDS applicable. One frequently asked question in exam, which is very frequent in real life also. Say this is India and this is UK. India, there is one company called X Limited which has appointed somebody called Mr. John as his agent for selling goods in UK market. Is the agent. Now naturally Mr. John is resident of UK. He is non-resident in India. In India this guy is non-resident. Okay. Now X Limited makes payment of commission to this person for helping it to sell assets in the UK market. Commission is paid. Now whether TDS should be applied or not. So answer: first priority will be given to these 20 sections as we discussed, but none of these 20 sections have, or none of these 20 sections cover commission payment. So priority will be given to, or now we will move on to section 195. 195 section says that first you check whether this commission is taxable in India or not. Now taxability of any income depends upon three things or three factors: place of accrual, place of receipt of income and residential status. Any of the three things is in India, then TDS will be attracted, then income is taxable in India. One thing for sure, that this person Mr. John is non-resident, so he is not resident in India. Place of receipt is also UK, therefore place of receipt point will not apply. Place of accrual. Now as far as commission income is concerned, place of accrual will be that country where services are rendered. Where is he rendering service? Answer is rendering services in UK. It's not Uttarakhand, United Kingdom I am talking about. So UK is not a part of India. So place of accrual is also UK, not in India. None of the three get attracted, none of the three get triggered income is not taxable in India, therefore no TDS. No TDS under any section. However, if income was taxable in India, then TDS liability would arise. As far as place of accrual is concerned, place of accrual, there can be actual real place of accrual, actual, or there can be deemed place of accrual. Income may be deemed to be accruing arising in India as per section 9(1). So, while deciding whether TDS under 195 is applicable or not, we have to first decide whether income is taxable in India or not. And to decide whether income is taxable in India or not, we have to decide three things: residential status, place of receipt of income, place of accrual of income. When we come to place of accrual of income, we have to consider two things: actual place of accrual and deemed place of accrual. For that, we have to refer to section 9. Residential status is governed by section 6. Place of receipt and place of accrual are all governed by or talked about in section 5, read with section 9(1). Deemed place of accrual. Okay. So, in Vodafone and Hutch case, the matter went up to Supreme Court and government also carried out retrospective amendment under the finance ministership of Pranab Mukherjee, where they clarified that even if the buyer of the shares is non-resident, that is Vodafone from UK was the buyer and the seller was Hutch Hong Kong foreign company, one foreign company buying from another foreign company, transaction taking place outside India, whether TDS applicable or not. So, government clarified it by inserting retrospective explanation to 195, saying that if income is taxable in India, then TDS will have to be deducted irrespective of whether that non-resident has a place of business in India or not, place of residence in India or not, permanent establishment in India or not, or any other kind of presence in India or not. Even if there is no presence of Vodafone while making payment to Hutch, while buying the shares of CGP, Cayman Island based company, even if Vodafone does not have place of residence, place of business, branch, PE, nothing is there in India, but since income is taxable by way of capital gain in the hands of Hutch India, Hutch Hong Kong is liable to tax in India, therefore TDS should have had been deducted. So, simply there is no exception. So, we had discussed it in the class that CBDT had issued a circular in 1995 August saying that one resident person makes payment to another resident for professional fees, then TDS is applicable. TDS is applicable under section 194J. When one resident makes payment to non-resident professional fees, TDS will still be applicable under section 195. One non-resident makes payment to resident, then TDS may be applicable or may not be applicable. Will depend upon may be applicable, may not be applicable. If applicable, TDS will be under 194J and not under 195. Why? Because payee is resident. CBDT issued circular in 1995 clarifying that if the non-resident payer has a PE in India, he has a permanent establishment in India or not. If he has a PE in India, then TDS is applicable while making payment. TDS section will be 194J only because payee is resident. Which section will apply? That depends upon payee. Payee non-resident, then 195. Payee resident, then 194J or any other section. Or does not have a PE in India, at the time of making payment, then TDS under 194, 194J or 194, none of them will be attracted. If non-resident, say for example, I work with some foreign company, sitting in India, I provide online service, they made me some payment of professional fees, then they are non-resident, I am resident, it fits into this situation. If I provide online service and they make me online payment, I don't go to their country, they don't come to my country, then no TDS. It will fall under this situation, no TDS. However, in case if they have a branch in India and they are making payment to me through branch, then TDS will have to be applied. Ideologically, government says if non-resident has some presence in India, has some arrangements to make payment of TDS, they can deduct TDS, they can deposit TDS, file TDS challan, then they should deduct TDS. But if they are totally out of India, have no presence in India, then we cannot expect them to learn Indian taxation law and comply with TDS provision. However, Vodafone and Hutch situation was none of these three. Vodafone and Hutch situation was one non-resident making payment to another non-resident, or one foreign company making payment to another foreign company. This was Vodafone, this was Hutch. But Bombay High Court as well as Supreme Court stated, and government also carried out amendment, that in this situation TDS is applicable if income is chargeable to tax in India. And chargeability to tax in India will depend upon three factors, which three we already discussed. Proceeding further, 196 ABCD are the next four sections. 196 ABCD, I'll briefly explain it to you. None of them are important from exam point of view as such. Questions have come recently, that too recently, just few years back, in the form of MCQ, but not that great. You can afford to take a chance. Now 196A is applicable to any person making payment to, here for these sections, payee should be OFO, Overseas Financial Organization, meaning thereby offshore fund or overseas financial organization. What is OFO and what is FII? How they are different we had discussed. FIIs and OFOs both are incorporated outside India. Both of them come to India for investment. Both of them require SEBI approval. The only difference is FIIs do not collaborate with anybody. They come to India directly. On the other hand, OFOs first collaborate with some public sector company or insurance company or bank. For FII, we have a separate section 196D. OFO, Overseas Financial Organization. For 196B, payee should be non-resident or a foreign company. Sorry, I made a mistake. For 196A, payee should be foreign company or a non-resident. 196B, the payee should be OFO. 196C, again non-resident or a foreign company. And for last 196D, for 196D there are two parts, 196D1 and 196D1A, FII or a specified fund. So technically we are going to discuss about 5 people. What is FII, what is specified fund, that also we had discussed. FIIs and specified fund, both of them have investors outside India who are residents of outside India. Both of them come to India for investment purpose. The difference is FII is incorporated outside India, specified fund is incorporated in India, referred to in section 10(4)(d). Referred to in section 10(4)(d). Okay, now different types of incomes will be taxable for them. For some incomes are taxable at 10%, and wherever there is a capital gain involved, till 22nd July 24, rate of tax as well as rate of TDS was 10% and for long term capital gain, and from 23rd July 24 onwards, if transferred on or after 23rd July, then instead of 10% earlier, now the rate will be 12.5%. TDS rate will also be 12.5% and income will also be taxable at that rate. Incomes we already talked about in special rates of tax chapter. Here 196A is the income governed by section 115A. OFO income is the one which is governed by section 115AB. 196C we have income from bonds and GDRs referred to in 115AC. For FII we have income referred to in 115AD, and for specified fund also 115AD. So it's 196D, then a section will be 115AD, 196C, then 115AC, 196B, 115AB, and 196A, then 115A. 4 sections of TDS chapter matching with or corresponding to 4 sections of special rates of tax chapter. One by one we will be discussing. 196A, non-resident or foreign company, which income? Income from units of UTI or mutual fund. Payer any person, payee non-resident or foreign company, income from mutual fund or units of UTI, acquired in foreign currency. Acquisition in foreign currency is a prerequisite condition. Not being capital gain on transfer of units. Here capital gains are not covered. TDS rate will be 20% or DTAA rate, whichever is lower. So technically for earlier sections I told you DTAA rates not to be brought into picture unless specified. So DTAA rates are to be brought into picture and compared with the rate in force only for 3 sections. Out of them, 2 of them are done by us. Number 1, it was this 195 section. Second is this section where DTAA rates are to be considered, 196A, and there will be one more section, 196D, which we will discuss. So clear with 196A, any person making payment to non-resident or foreign company will have to deduct 10% TDS, 20% or DTAA rate, whichever is lower, in case if the income is income from units of UTI or mutual fund, other than capital gain. 196B is the next section. Any person making payment to OFO, Overseas Financial Organization or Offshore Fund, TDS rate will be 10%. Income is the same income which we talked about in previous point. Income in respect of units referred to in 115AB acquired in foreign currency. However, unlike 196A, where capital gains were not covered, here in 196B we will be covering capital gain also. TDS is applicable on capital gain also, but not on short-term capital gain arising from units, only on long-term capital gains arising from transfer of units. Normal income 10% TDS rate. If it is long-term capital gain arising from transfer of units, if sold up to 22nd July 2024, then 10%. On or after 23rd July 24, rate will be 12.5% TDS rate plus surcharge, of course, plus health and education sets wherever applicable. 196C is the next section. This is applicable to incomes referred to in section 115AC. Payee should be non-resident or a foreign company, payer any person. Incomes, 2 types of income, income from bonds and GDRs of Indian company. As far as income from bonds concerned, bonds should have been acquired in foreign currency and it should be bonds of notified Indian company or notified public sector company, that is government company, provided bonds are acquired in foreign currency. Same is the story with GDR, dividend from GDRs of Indian company, GDR from Indian company. Okay, and as far as bonds and GDRs are concerned, common point is that both should be of Indian company, both should have been acquired in Indian currency. From bonds, foreign currency, from bonds we can have interest income and from GDR we will have dividend income. These income, recurring incomes to be taxed at 10% that we already discussed, regular income 10%, and if it is capital gain, then short-term capital gains are not covered, long-term capital gains. Long-term capital gain will be taxed either at 10% rate or 12.5% rate depending upon the date of transfer. 196D has 2 partition, subsection 1, subsection 1A. Payer is same, any person, but in subsection 1, payee is FII and in subsection 1A, payee is specified fund. What is specified fund? We already discussed. Which incomes? Here again capital gains are not covered, only recurring income, income from securities. Securities, that means shares, debentures, bonds, securities which are acquired in any currency. Here again foreign currency acquisition is not a prerequisite condition. Securities could have had been acquired in any currency, but it should be other than capital gain, long term, short term, arising on transfer of securities. Other than capital gain, rate will be 20%. If it is FII, then 20% or DTAA rate. If you observe, DTAA rates are to be taken into account only at 3 places. Which 3 places? Number 1, 195, 196A and 196D1. 196D1 for FII, not for specified fund. All the 3 places, these 2 places the rate is 20% or DTAA rate. Here also 20% or DTAA rate, whichever is lower. But the rates given here should be increased further by applicable rate of surcharge and health and education sales. Same income, in case the payee is specified fund, then TDS will be at 10% rate without considering DTAA rate. TDS will be only on recurring income, income from securities acquired in any currency. No long-term capital gain, no short-term capital gain. Long-term, short-term capital gain will be taxable as per rate given in section 115AD, but TDS will not be there. Same thing I told you in special rates of tax chapter also while discussing section 115AD. You can have a look at that or you can see the video of that. Technically, all 41 sections are over. There are some points to be noted. Some of the points are important and interesting also. Points are all interesting. Some of them are very important. First and last section of the chapter, section 191 and section 205. Very first section of this chapter, before even 192, salary TDS, 191 section says that it is the responsibility of payer to deduct TDS. What if payer does not deduct TDS and makes full payment? Like JK Shah classes, they forget to deduct TDS and they pay me full amount. Then government can recover that much amount from the payee. Payee will be responsible to pay that much amount directly to government. Why? Because 10 lakh rupees, for example, is the amount involved. 1 lakh rupees should have been TDS. JK Shah classes should have paid me 9 lakh rupees, but they ended up paying me 10 lakh rupees. The moment they decide to pay me, or the moment they credit my account 10 lakh rupee, out of that 1 lakh becomes government's property instantly. Though government allows time limit of 7th of the next month to deposit that much, to deposit TDS, but still the moment JK Shah classes credit my account by debiting PNL, or the moment they pay me, TDS liability arises and that much TDS amount becomes government's property. So government says if JK Shah classes forgot to deduct TDS, then that 1 lakh is lying with Nihit sir. Let's recover from Nihit sir. They can officially recover from me. However, section 205 says if JK Shah classes payer deducted TDS but they did not deposit with government, then government's responsibility is to recover from JK Shah classes along with, that is payer, along with interest, penalty, fine, etc. Credit will have to be given to me. That much amount cannot be recovered from me now because I have received only 9 lakh rupee. Government's 1 lakh rupee to the extent of TDS is still lying with JK Shah classes. Okay. Then at what point of time is the tax deductible? So answer, tax is deductible either at the time of making payment to the payee or at the time of crediting payee's account, whichever is earlier, subject to 8 exceptions. In following 8 sections, TDS is not to be deducted at the time of payment or credit, whichever is earlier. TDS is to be deducted at the time of actual payment only, which we have already discussed at the appropriate places. First is section 192 salary, second is 192A EPF account withdrawal, third is lottery winning from lottery, crossword puzzle, card game or gambling betting, 194B, next is 194BB, winning from horse race, 192, 192A, B, double B. 194DA, maturity proceeds of life insurance policy if it is not exempt under 1010D. 194EE, which is totally unimportant, NSS account withdrawal. Then 194F is deleted now, which is withdrawal from or repurchase of units referred to in section 80 CCB. And 194N, withdrawal from bank account, any bank account of 20 lakhs or more than 20 lakhs or more than 1 crore or more than 3 crore. Okay. Fourth point we are already done with. There are out of total 41 sections, there are 6 sections where individuals and HUFs are not required to deduct TDS unless their last year's turnover from business exceeded 1 crore or last year's professional gross receipt exceeded 50 lakh rupees. 194A, C, H, I, J and 194R. 194A is interest other than interest on security. 194C, contract charges payable to contractor exceeding 30,000 per payment or 1 lakh exceeding 1 lakh rupee for the whole year. 1% or 2% TDS depending upon legal status of the payee. 194H, commission brokerage other than those covered by 194D or 194G exceeding 15,000. 5% is the rate of TDS, but from 1st October 2024, rate has been brought down from 5% to 2%. 194I, TDS on rent, rent of 8 assets, rent exceeding 2,40,000 for the whole year. TDS rate will be 10% on the rent of land, building, furniture fitting, and it will be at the rate of 2% in case if it is a rent of plant, machinery, equipment. 194J, professional fees exceeding 30,000, but there were 5 payments: professional fees, fees for technical service, payment to a director of a company which is not covered by section 192, royalty and non-compete fees. TDS is at different rates, ideally 2 rates, 2% and 10%, and 194R, benefit perquisite arising from exercise of business or profession exceeding 20,000, TDS rate will be 5%, 10%, sorry. Okay. Fifth point, 195A, grossing up principle. This we had discussed. On this, couple of questions have come, though it's a stupid provision, but our institute finds it very interesting. It says that normally if the payment is 1 lakh rupee and the TDS is liable on it, TDS is at the rate of 10%, then 10,000 TDS, and accordingly 90,000 will be the net of tax payment. This will be the net payment and this will be called as a gross amount. So, percentage wise this is 100%, this is TDS is 10% and accordingly 90% payment is going to be made. However, if somebody does not understand in TDS or he is a non-resident, foreign national, or for any reason, if the payee and payer have agreed that TDS will not be deducted, or rather payment will be made without deducting TDS, that means if supposingly 1 lakh rupees is going to be paid net of tax or without deducting TDS, then one will have to calculate the TDS. Tax is always deductible and to be deposited with government account, but we'll have to go backwards in a reverse order. Earlier 1 lakh was the gross amount and this was the net of TDS, 90%. However, if somebody wants 1 lakh rupee net of tax, then that 1 lakh will be reflecting 90%. If 1 lakh is 90%, how much is 100%, how much will be 10%? We'll have to go backwards. This will be 1 lakh 11,111 and TDS accordingly will be 11,111 as compared to 10,000, payer will have to deposit 11,111. How much? Two more questions. How much deduction will be allowed to the payer while entering into such arrangement? Answer, payer will get deduction of expenditure of 1,11,111 under grossing up principle. And how much will be deemed to be the income of the payee? Payee's income will also be 1,11,111 and not 1 lakh, irrespective of method of accounting. Why is it so? Because of section 198, which says that TDS is also an income, whether it is deducted this way or it is deducted and or without deducting deposited directly by payer this way. If it has been agreed to make payment net of tax basis or without TDS, remember in exam whenever a question comes, either of these two phrases should be there. It should have been given in the question that payment is going to be made net of tax basis or without TDS. Then only you will apply grossing up principle. Otherwise, don't end up applying grossing up principle blindly, randomly. Okay, then such net of tax amount shall be increased to such an amount, gross amount, in such a way that such grossed up amount after TDS at appropriate rate becomes equal to net of tax amount. 196 is an important section for real life also, exam also. No TDS under any of the above mentioned section if the payee is any of the following 5. Number 1, payee is central government or state government. Number 3, statutory corporation, RBI or any mutual fund. If these people are the payee, 5 people, then nobody shall deduct TDS under any section. This 196 is a general exception applicable for the whole chapter for all the 41 sections. Up till now, whatever exceptions that we had discussed were all section specific exceptions, were applicable only to given section. For example, section 194A, where we had discussed interest other than interest on security, we had discussed if payee is bank, recipient is the bank, then nobody shall deduct TDS. There I had given an example, if you have put FD with a bank, bank pays you interest, bank will have to deduct TDS if amount exceeds the threshold limit. But reverse way, you have taken loan from bank, you are paying interest to bank, bank is the payee, then you don't have to deduct TDS. But bank is not appearing here. Answer, I am talking about 194A. What I was saying was that's a section specific exception. Bank is the payee, then don't deduct TDS under 194A, only 194A. If bank is a payee for some other section, then TDS may be deductible. Okay. 7 point you need to remember a little bit, GST on goods, GST on services. So no TDS on GST on services if shown separately in the bill or invoice, but TDS will be applicable. I mean no TDS on GST on services, but TDS will be applicable on GST on goods. Deducting TDS on GST component does not amount to tax on tax situation or double tax situation, because it is clarified by government that TDS is just withholding of tax. It is not charging of tax or levy of tax. So by applying TDS percentage on the GST on goods, we are just withholding the tax on GST component. We are not actually charging income tax on GST, except in case of 194Q. 194Q is an exception given by CBDT by issuing circular, which we had discussed. No TDS on GST on goods under 194Q. 194Q is for purchase of goods exceeding 50 lakh rupees in a year by a buyer whose last year's turnover exceeded 10 crore rupees. Here no TDS. No TDS on GST on goods. Barring this, all other sections like 194C or any other section, TDS will be attracted on GST component also if it is GST on goods. GST on services, no TDS at all. GST on goods, TDS is applicable except for 194Q. Next, no TDS on personal purpose payment under section 194C and 194J, payment to contractor or payment for professional fees by individual or HUF for personal purposes of individuals or HUF. This we had discussed while discussing these two sections with example of Mukesh Ambani, if you recollect, in the previous session, part 1 of TDS revision. If you recollect, barring these two sections, for any other section, if payment is made for personal purpose, for example, rent is paid. For rent, TDS is either attracted under 194I if rent exceeds 2,40,000 for 8 assets, or TDS may be deductible under 194IB if the rent exceeds 50,000 per month, 50,000 in a month by those individual HUFs who are not required under 194I. Okay, here even if the rent is for personal house, then also TDS will be applicable. Then 206AA and 206AB, interesting section which are applicable for the whole chapter, subject to some exception. 206AA, while making payment to such a payee who does not furnish his PAN number, permanent account number, or who does not have the permanent account number, then TDS will be either at the rate applicable or at the rate of 20%, whichever is higher. Then payee does not furnish PAN number, TDS will be at the rate applicable or at the rate of 20%, whichever is higher, except in case of 194LC and LD. 194LC, LD we discussed here few minutes back. 194LC means business trust or Indian company paying interest to non-resident or a foreign company, interest on borrowed capital, provided borrowing is in foreign currency, borrowing is by way of loan agreement or issue of long-term infrastructure bonds or any long-term bonds, or by issuing rupee denominated bonds, 5%, 4%, 9%, that. And 194LD means interest payable to FII or QFI up to 30th June 2023. Interest on rupee denominated bonds of Indian company, interest on government securities, and interest on municipal debt security, all three payable up to 30th June 23. Last year section has become redundant. Okay. Now not only except of 194 LCLD, but even following section also TDS will be as per following table. Normally what will happen? Rate applicable or 20%, whichever is higher. Agreed. But in following 1, 2, 3 sections, out of which 192A is no more applicable for this particular table, two exceptions, 194 LCLD plus two more exceptions, 194Q and 194-O. 194O, that is online, that is payment made by e-commerce operator to e-commerce participant. Rate is 1%, 1st October 24 onwards 0.1%, otherwise earlier it was 1%. Instead of 1% or 0.1%, if 206AA gets attracted, payee has not furnished PAN number, TDS will be at rate applicable or 5% instead of 20%. And 194Q, important section, 0.1% is the original official rate. Instead of 0.1%, if PAN number is not there, then TDS will not be at 20% rate. Instead of 20%, upper limit will be 5%. 206AB, making payment to non-filer. Non-filer means person who fulfills three conditions, also called as specified person. While making payment to specified person means a person who fulfills three conditions. Number 1, he has not filed IT return of the immediately preceding previous year. Last year's IT return not filed, plus due date to file the IT return given in section 139 subsection 1, that is original IT return due date 31st July or 31st October or 30th November. IT return not filed, due date has also expired. Plus third condition, TDS plus TCS in such last immediately preceding previous year, TDS plus TCS combined together of last year was 50,000 or more than 50,000. Then TDS will be applicable either at twice the rate applicable, double rate or 5%, whichever is higher. However, there are some exceptions to this section. This concept does not apply twice the rate or 5%. In case of 192 salary, 6 exceptions are there. 192A EPF account withdrawal, 194B winning from lottery, crossword puzzle, card game or gambling betting, 194BA online net winning from online games, 194BB winning from horse race, 194IA purchase of immovable property for 50 lakhs or more than 50 lakh, actual sale consideration as well as stamp duty value, both should be 50 lakhs or more than 50 lakh, 1% TDS deductible. 194IB rent for immovable property, not for plant machinery furniture fitting, rent for immovable property under section 194IB, TDS will be at 2% or 5%. Earlier it was 5%. Now from 1st October 2024, rate is brought down to 2%. Payable by individual HUF who are not covered by 194I. 194 LBC we just discussed. LA, LB, LBA, LBB, LBC, BIS, Bureau of Indian Standard. So LBC would mean Securitization Trust. 194M, 194N. 194M means payment exceeding 50 lakh rupees by individual HUF who are not required to deduct TDS under 194C, 194H and 194J. Last is 194N, cash withdrawal from bank. So what do you mean by specified person? Specified person means 3 conditions: not file IT return of the immediately preceding previous year, due date has expired, and third, TDS plus TCS combined together is 50,000 or more. However, specified person will not include following two. Number 1, a non-resident who does not have a permanent establishment in India. Non-resident does not have PE in India, meaning thereby if he is a resident, PE is resident, or PE is a non-resident having PE in India, then TDS at the rate of double rate or 5% will be applicable as given in 206AB. Secondly, 206AB also does not apply to a person who is notified by central government and is not required to file IT return of the last year and is notified by government. Okay. If both of them become attracted, 206AA as well as 206AB, then TDS shall not be applied under both the sections. TDS shall be applied under that section which has the highest rate of TDS, which is higher amongst these two sections. 94A, which I told you we will discuss in transfer pricing chapter. Here also in revision lecture also, 94A is a payment by a resident person to any person whose localite or whose resident of notified jurisdictional area. Notified jurisdictional area means an area or a country or a territory which is announced or declared by our government to be a notified jurisdiction area. Up till now, only one country was declared as NJA, notified jurisdiction area, Cyprus, and Cyprus started cooperating with us, so we denotified also. As of today, in December 24, there is not a single country which is notified for this purpose. If you as a resident make payment to any person, resident of notified jurisdiction area, you will have to deduct TDS at the rate applicable or 30% flat, whichever is higher. 13th point is about 194R, which we are done with, CBDT circular in the form of question answer. This is interesting, this you keep it in your mind. Up till now, CA final stage questions have not come on this. Question likely to come anytime, keep it in your mind. What is it? In case if one person provides benefit perquisite to other person and the benefit perquisite is not personal in nature, it is in connection with exercise of business or profession, then and the amount exceeds 20,000 rupees, then payer will be required to deduct TDS. Many a times social media influencers, they take money from the corporates and they do unboxing in front of camera, unboxing of the product, or they submit their review after using that product. And then those who are followers, it's a very good way of advertisement, and that is the need of the present time. In such situation, for benefit perquisite, If benefit perquisite is given to the social media influencer for using it, then whether TDS under 194R will be applicable or not. So CBDT clarified that in case if the product after unboxing and using it by social media influencer, if the product is going to be taken back, then no TDS, even if going to be taken back after some period of time. And if it is not going to be taken back, then TDS will have to be applied 10% if the value exceeds 20,000. As far as valuation is concerned, CBDT clarified value depends upon whether goods given or perquisite given is manufactured by assessee itself or it is purchased. If it is purchased by assessee, by the payer, I purchase and give it to somebody in connection with my business profession. I purchased iPhone 16 for let's say 89,000, and 89,000 worth of phone I gave it to somebody as a benefit or perquisite in connection with exercising of business or profession. Then which value? Then answer, whatever is the purchase price, actual purchase price. If it is manufactured by assessee himself, payer himself, then ideally you might be thinking we should take the manufacturing cost, but instead of manufacturing cost we have to take FMV, that is price which the company charges to its customers, and not only the manufacturing cost. And last, in any other case, which other case is possible? First point, purchase from outsider. Second says manufactured by assessee and given it to somebody. Third possibility, any other case would ideally mean a situation where assessee also received it as a gift and passing it on to employee. Then FMV of such product or benefit perquisite prevailing on the date of gifting will be taxable. GST will not be included in the value of benefit perquisite while calculating, because GST is going to be claimed as ITC, input tax credit. So I purchase for 100 rupee plus I pay 18 rupee GST, total 118 I paid. That product I am giving to you in connection with business profession of mine. Then in your hands what will be taxable will be only 100 rupee, the market value of such product, and not 118, because for 18 rupee GST paid for purchasing this product and to giving it to you, the 18 rupee GST paid by me, I am going to claim ITC, input tax credit. Other points relating to 194R. Okay, here some points are given, nice points by CBDT circular. I have briefed it up. Number 1, TDS will be applicable even if benefit perquisite is capital receipt in nature. In the hands of recipient, it is capital receipt. Say I am a manufacturer of car, Maruti Udyog. For me, cars are stock in trade. I gave one car to the employee. For employee, it becomes capital receipt. Whether it is capital receipt or it is revenue receipt, revenue in nature, makes no difference. TDS will be attracted if other conditions are satisfied. Okay, one very interesting thing, it is not necessary for payer to check whether the value of benefit perquisite is taxable in the hands of payee or not. So, simple language, even if perquisite is not taxable for payee, then also TDS will be applied at the rate of 10%. Even if not taxable, then also TDS will be applicable under this section. Under which head of income the benefit perquisite is taxable in the hands of payee is absolutely immaterial. Whether taxable under the head PGBP or IFOS or capital gain, that is immaterial. Okay. Now there is a clarification that if seller is offering perquisite to buyer or dealer, if the things which are given are based on requirement of pre-purchase. If I tell you, you purchase 5 units from me, 5 bags from me, I will give you 6 one free, or I will give you 50 rupees discount. Then in such situation, that discount or freebie is given by me to you should not be regarded as, should not be liable for TDS. If seller offers some free units to the buyer upon purchase of particular quantity, then no TDS under this section. But if free samples are distributed without any hidden requirement or condition of prior purchase, then TDS will be applicable even if the value exceeds, TDS will be applicable if the value exceeds 20,000 rupees for the whole year. Okay, then E point. It says TDS is applicable under 194R only if the payment is for business or arising from business or profession of the payer. Therefore, no TDS if the benefit perquisite is personal in nature, then no TDS. So just like 194C and 194J, no TDS if payment is for benefit perquisites are for personal in nature. Okay, TDS is applicable even if the benefit perquisite is ultimately diverted to the employee or the director of the recipient or their relative who are not carrying on any business profession. So company gave pharmaceutical drug to hospital. The hospital did not use it. Hospital gave it to its doctor. Doctor is an employee. Then double TDS. What will happen in such situation? CBDT clarified. Pharma company making payment to hospital. Hospital gave it away. Of course, if the value exceeds 20,000, hospital gave it away to Mr. D, the doctor working as an employee doctor working in this company. Then pharma company will be required to deduct TDS under section so and so. Hospital, while making payment to Mr. D, they will also be required to deduct TDS. TDS will be by both of them under 194R, under 194R. TDS will be applicable in both the situations. However, prior point we said hospital, pharma company gave it to hospital. Hospital is an artificial person, or let's say it's a company. Company finally handed it over to its employees. Then in such situation, then what will happen? Company gave it to employee, then double TDS. Pharma company will have to deduct under 194J and company as an employer will have to deduct under 192 section. All these small points are clarified by CBDT. Reimbursement of out-of-pocket expense will also not be charged as benefit perquisite and will not attract TDS under 194R. Out-of-pocket expense reimbursement will ideally not be considered as this. Dealer conference. Dealer conference is slightly big. Dealer conference, it says two possibility. If it is for all the dealers, dealer conference whether conducted in the same city Mumbai or taken to everybody, all dealers are taken to Goa or any tourist destination where hotel expense, to and fro, everything is sponsored, then in such situation that expenditure incurred on the dealer, if the conference is for all dealers without any discrimination, then no TDS. However, if the benefit perquisite by way of seminar or dealer conference is held only for selected dealers, by default it does not amount to benefit or perquisite, but if such conference is held for select dealers or select customers who have achieved particular target, then it will amount to benefit or perquisite. Accordingly, 194R will apply. Till you are done? Okay. Then last one page or one slide is left out. Here we have described in detail the 5 types of responsibilities of the deductor or the payer. If I am the payer paying you and all conditions are fulfilled with regards to threshold limit and other things, then payer is responsible to deduct TDS. After deducting, he has to deposit. After depositing, he has to file TDS statement, quarterly statement, and after that he has to issue TDS certificate to the payee. Deduct, deposit, file TDS challan, download certificate and issue TDS certificate to payee, and last one, which was actually the first one, section 203A, tax deduction account number. Accordingly, TDS account number should have been applied by every person who is responsible to deduct TDS. So first responsibility is to deduct, second deposit, third responsibility is to file TDS statement, fourth responsibility is to issue TDS certificate, and fifth responsibility is to apply for tax deduction account number. Let's start. So starting with the first responsibility, payer has to deduct. All responsibilities are of the payer. Deduct under which section and at what point of time? So answer, deduct under section 192 to section 196D, either at the time of actual payment or at the time of crediting the account of the payee, whichever is earlier in point of time, subject to 8 exceptions. If not deducted, then what will happen? So that punishment is common between first point and the first responsibility and the second responsibility. So let's finish with the second responsibility first. Second responsibility is to deposit. Depositing is given in section 200 subsection 1. The TDS for 3 sections, 194IA, 194IB and 194M, these 3 special sections, TDS is to be deposited within 30 days from the end of the month in which deducted. 194IA, purchase of immovable property for 50 lakhs and more, or 194IB, rent of 50,000 or more than 50,000 a month, and 194M, payment exceeding 50 lakhs by individual HUF who are not required to deduct TDS under 194C, 194J or 194H. So for these three sections, the TDS is to be deposited within 30 days from the end of the month in which deducted. For all other sections other than these three, TDS to be deposited by 7th of the next month. 7th of the next month means month succeeding the month in which deductible. If deductible in the month of January, then deposit by 7th February. Deductible in February, then deposit by 7th March. However, for March month, if the tax was deductible in March month, then instead of 7th April, time limit will be 30th April. So first 11 months, if tax deductible in first 11 months, then deposit by 7th of the next month. If tax deductible in the month of March, then deposit by 30th April. Now what will happen if neither deducted nor deposited, or either deducted but not deposited? Then in such situation, if the tax is not deducted or not deposited failure, then 1, 2, 3, 4, 5 punishments appearing on the right hand side. Number 1, first punishment, as per section 2011, assessee will be deemed to be an assessee in default. Meaning thereby, assessee will be declared as a defaulter by passing an order in writing. Assessee will be declared as a defaulter, then once he is declared as a defaulter, necessary recovery proceedings can be initiated against him forcibly. His bank accounts can be freezed, movable, immovable properties can be attached and so on. However, if 4 conditions are satisfied which are given down the line, then assessee will not be deemed to be an assessee in default. And secondly, if the company commits the default, then apart from company, the principal officer of that company will also be considered as a defaulter. Apart from assessee declared as a defaulter, there will be interest. Interest under section 201 subsection 1A. For some part, interest will be 1% per month, and for some later part, interest will be 1.5% per month. Per month includes part of a month also, meaning thereby incomplete month will be considered as one full month. If the delay is of 3 days, 3 months and 1 day, 3 months and 1 day, interest will be charged for 4 months. That's one thing. Secondly, whether 1% or 1.5%, interest will be simple interest. No compounding effect means no cumulative interest. However, interest will stop after particular date if some conditions are satisfied. Which condition we will discuss. From what date to what date interest will be 1% per month? Answer. Time limit to deposit TDS is 7th of the next month. But interest will not start from the 8th of the next month. Interest will start from the date on which tax was deductible. Tax was deductible till the date tax is deducted. Interest will be, for that period, interest will be 1% per month or a part of a month. Tax, the date on which tax was deductible till the date on which tax is actually deducted, 1% per month. And then the date on which actually deducted till the date on which deposited, 1.5% per month. Plus penalty under section 271C, which will be equal to the amount in default. Plus prosecution, that is imprisonment, ranging between 3 months to 7 years plus fine. And fifth and the last, one more punishment, disallowance of expenditure. Any payment made without TDS or without depositing TDS. Either of the two defaults. Number 1, tax is not deducted by 31st March of the financial year, by year ending, or number 2, deducted but not deposited on or before the due date of filing IT return. Not deposited on or before the due date of filing IT return, and not necessarily by 7th of the next month or 30th April. If tax is not deducted by year ending, or tax is deducted but not deposited by on or before the due date of filing IT return, then disallowance will be attracted. Under section 40 clause A, 40 clause A has got 3 subclauses for TDS related disallowance. 40 clause A subclause 1, 100% of the amount will be disallowed. 100% of the expenditure will be disallowed in case while paying to non-resident or foreign company, 100%. 40 clause A subclause 1A, 30% of the amount will be disallowed if payable to resident, and 40 clause A subclause 3, 100% will be disallowed in case if it is salary payable to non-resident outside India and tax is neither deducted nor deposited. Out of these three, first two are temporary disallowances, right now disallowed, but later on when the conditions are complied with, provisions are complied with, at that time whatever was disallowed right now will be allowed as a deduction later on. How much will be allowed? So answer in first case 100% was disallowed, then 100% will be allowed later. 30% was disallowed, that means 70% was allowed right now. So whatever is disallowed, 30% will be allowed whenever conditions are complied with. And here this is a permanent disallowance under 40 clauses subclause 3. Here no recouping back. Here once disallowed, it is disallowed lifetime. That was the second responsibility of the payer. He has to deposit within the time limit. Which four conditions here we discuss? First punishment, payer will be deemed to be in default and interest will be charged. So payer will not be deemed to be in default for failure to deduct TDS if four conditions are fulfilled as per proviso to section 2011, and from that date and from if these four conditions are satisfied, then two reliefs will be given to payer. Number one, payer will not be deemed to be defaulter, and secondly, interest under 2011A will stop after particular date. Which date is it? Let's try to understand, and what four conditions are to be fulfilled given in proviso to section 2011 and proviso to 2011A. If I am the payee, JK Shah classes is the payer, they pay me without deducting TDS, then only this facility is available. If they paid me after deducting TDS but they did not deposit TDS, then this concept is not applicable. This concept or this benefit or this relief is available to the payer JK Shah classes only if they fail to deduct TDS. Number one, if payee fulfills four conditions. Number one, payee files IT return, maybe within the due date or belatedly, that is immaterial. Payee should file IT return for that year. Number two, payee includes such income in the IT return which he has received without deduction of tax. Such income which he has received without TDS is included in such IT return, and the tax payable as per IT return is paid tax due as per IT return. Not necessarily amount equivalent to TDS amount. If 10 lakhs is paid to me, TDS should have been 1 lakh rupees, but my tax payable works out to be 3,50,000. Then I should have paid 3,50,000. Not necessarily only 1 lakh, but TDS would have been 1 lakh, but my tax payable works out to be 80,000. Then I should have paid 80,000. Whether it is less than the TDS amount or more than the TDS amount, that is immaterial. I should have paid tax as per my IT return, and I need to furnish CS certificate in form number 26A. No need to remember form number, certifying that all the first three conditions are satisfied by me. This 26A to be furnished online by payee to the payer, and then my CA will furnish it and I have to transfer it to the payee, and then payee can submit it to the income tax department. If these four conditions are satisfied, then two benefits: payer will not be deemed to be in default from the date of filing IT return, not from the date of paying tax, not from the date of payment of tax by the payee, but from the date on which payee files IT return. Secondly, interest will also stop. Payer will be benefited twice in two ways. He will not be deemed to be in default and interest will stop. But interest will be charged for some period, and for some period interest will not be charged. From what date interest will stop to the payer? Interest under 2011A will stop after the date of filing IT return by payee and not from the date on which payee pays the tax. Logically, the benefit should be given to the payer from the date on which payee pays the tax. From the date I pay the tax, because government's money 1 lakh rupee TDS amount was lying is lying with payer. That's why government is charging interest. Now government's money government has received not from payer but from payee. Then interest should stop from the date of making payment. However, as far as date of making payment is concerned, what if payee paid in 4-5 installments, 4 times advance tax, 1 self-assessment tax? Then it is practically, say I paid in totality, I paid 6 lakh rupees tax. Then out of 6 lakhs on different dates, on which date I paid 1 lakh rupee of JK Shah classes? When did I pay that? Exactly on which day I paid that 1 lakh rupee? It is not practically possible to identify, but it is possible to identify the date of filing IT return by payee. That date is identifiable accurately That is the reason government has kept the provision like this. Interest will stop on JK Shah classes and they will not be deemed to be in default after the date I file IT return. And as far as disallowances are concerned, one more benefit, disallowance will be reversed, or rather disallowance will not be attracted if instead of payer, payee fulfills these 4 conditions. Then payer will not be facing disallowance 30% or 100%. However, understand very clearly, for the time being disallowance will be attracted in case if JK Shah classes people, they paid me for 1st April 24 to 31st March 25. For this year, the due date of filing IT return will be following, this is financial year or previous year 24-25, for which due date to file the IT return by me will be due in financial year 25-26. Say 31st July is the IT return due date, and then one day my assessment year will come to an end on 31st March 2026, AY 25-26. which is financial year 25-26 also. Now what will happen is, JK Shah classes people paid me here in this year, they paid me 10 lakh rupees without TDS. And if they are caught, 30% of this will be disallowed, 3 lakh will be disallowed. Disallowed in which year? Disallowed in this year. Then I am filing IT return, I am including 10 lakh in my IT return and I am paying tax at the appropriate rate and furnishing CS certificate in form 26A. But when will I be doing this? JK Shah classes will be relieved about all these punishments from the date on which I file IT return. When will I be filing IT return? Naturally, IT return for this year, previous year 24-25, I would file in 25-26 assessment year. 15 July 25 is the date of filing IT return. ROI filed by payee. Then in such situation, JK Shah classes will be relieved from this date, meaning thereby disallowance under 40 clauses, subclause 1, 1A, etc. will be attracted for this year. Because TDS is not deducted by 31st March. JK Shah classes have not deducted TDS. And JK Shah classes will be relieved, or JK Shah classes disallowance will not be attracted after the date of filing IT return by me. I am filing IT return in financial year 25-26. So for 24-25 disallowance will be attracted. And then whatever is disallowed in 24-25 will be allowed as a deduction in 25-26, namely the year in which payee files IT return. So date on which I file IT return, on that day JK Shah classes will be deemed to have deducted as well as deposited TDS. 15 July 25, JK Shah classes have not yet deducted, they will be deemed to have deducted TDS on this day and deemed to have deposited TDS on this day. Payer will be deemed to have deducted and deposited TDS both, deducted as well as deposited on the date of filing IT return by payee, and accordingly amount disallowed to the payer under 40 clauses subclause 1 or subclause 1A will be allowed as a deduction in that previous year in which IT return is filed. IT return is filed by me in 25-26, JK Shah classes will get deduction of disallowed amount in 25-26. Deduction will be allowed in 25-26, but 24-25 financial year disallowance will surely be attracted. In current year, disallowance will certainly be attracted. Okay. Now, third responsibility is to file TDS statement. The way we file annual IT return, here person responsible to deduct tax has to file quarterly basis statement of TDS. This is governed by section 200 subsection 3. There is a specific form for that. 3 different forms are there, plus 3 more forms for 3 special sections. Okay. So for these 3 special sections, 194IA, IB and 194M, for these 3 sections, TDS statement is not to be filed separately, not required to be filed. These 3 sections, whenever it was deposited, it was depositing cum TDS statement. Depositing could be done by way of some challan, it would be deposit challan cum TDS statement combined together. So these 3 people deducting under these 3 sections, they don't have to file TDS statement separately. So technically time limited, it says 30 days from the end of the month in which it was deducted, So that only is the time limit for depositing TDS, and that only is the same as the time limit for filing TDS statement. But I mentioned no need to file separate TDS statement for these three sections. TDS statement is supposed to be in form 26QB, QC and 26QD for these three sections. That challan number itself is a TDS statement. For other sections, TDS statement has to be filed on a quarterly basis. Within what time? So answer 1 month from the end of the quarter. First quarter is April, May, June. 1 month from the end of June, 31st July is the last date. Second quarter is July, August, September, then 31st October. October, November, December is the third quarter, then 31st January. Only for last quarter some extra time is allowed. Last quarter is January, February, March. Instead of 30th April, 1 month from the end of quarter, time limit will be 31st May. TDS statement will be in form 24Q for salary for 192 section, will be in 27Q in case if payee is non-resident, and 26Q for all other payments. Form numbers not required to be remembered. 6 form numbers are there. In case if assessee discovers any omission or any wrong statement in such TDS statement filed earlier, assessee can file revised statement, which is called correction statement. Earlier there was no time limit to file correction statement. Now time limit is imposed. Time limit to file revised TDS return, or you call it as correction statement, will be 6 years from the end of the financial year, in which 6 years from the end of the financial year in which the payment was made or credit entry was passed, whichever is earlier. Okay. Default, then 234E fees, if not filed within time limit, 200 per day of default. However, fees shall not exceed the amount of TDS. Keep it in your mind, 200 per day, everyone remembers. 200 per day, for here it will start from 1st August, here it will start from 1st November, next day onwards. Plus penalty under section 271H, penalty will be minimum 10,000, maximum 1 lakh rupees. However, levying of penalty is a discretionary power of AO. AO may or may not. Fees is mandatory. AO has to. AO cannot bargain in this. Mandatory. Next responsibility is to issue TDS certificate. TDS certificate for salary, it will be in form number 16 for these three sections, 194IA, IB and 194M. Salary, this TDS certificate will be in form number 16B, 16C, 16D, 16BCD for these three sections. Time limit is 15 days from the due date of filing TDS statement. TDS statement time limit was 30 days from the end of the month plus 15 more days. Form 16 for salary under 192 by 15 June of the next financial year. 15 June of the next financial year. And for all other sections, TDS certificate time limit will be 15 days from the expiry of due date for filing TDS statement. TDS statement filing due date is quarter wise. First quarter April, May, June. Then due date for filing TDS statement is 31st July, 1 month from the end of quarter. 31st July plus 15 more days. 15th August will be the due date for quarter 1. Second quarter July, August, September. So 31st October is the due date for filing TDS statement. Here will be 15 November, 15 days extra. Same way, next quarter will be October, November, December. 31st January, here will be 15 February. And last quarter, April, that is January, February, March. Then instead of 30th April, time limit to submit TDS statement was 31st May. 31st May plus 15 days, 15 June. If not issued to the payee, to 500 rupee per day will be the penalty under section 272A subsection 2. And last requirement of the payer or deductor is to apply for 10 number. Actually, this should be the first requirement. Every person who is required to deduct TDS under any section is required to apply for separate number apart from permanent account number. He has to apply for tax deduction account number, TDS account number, that is 10 number. If not applied or applied but not, if after obtaining it is not quoted wherever required or false number is quoted, then 10,000 rupees of penalty under section 272BB. One more thing, TDS account number 10 number is not required for these three special sections, 194IA, IB and 194M. That's it. With that, revision of TDS chapter comes to an end. Thank you very much. See you in the next video. Wish you all a very good luck, and we shall see you again in the next video for some other chapter.